Here's what's coming up on the program. IMF board approves $191 million loan to Central African Republic. The Bank of Botswana holds monetary policy rate at 2.65%. Plus, Nigerian bonds tumble on fears energy subsidies will be extended. Hello and welcome to Business Incorporated, the final edition for the week. I'm Will Ibong. Let's get started. We begin as always with market numbers in Africa, where major equities were trading mixed at intraday. Nigeria's NGX was up 0.42%, while South Africa trended downwards 0.66%. Up north, Egypt's EGX 30 closed for the week on Thursday, printed a nearly 2% increase, while Kenya closed marginally up for Thursday's session, still in positive territory. Now, let's make a move now to the Middle East, where most equities were closed on Thursday, except for the markets in the UAE. Abu Dhabi was up 0.68%. So as well with Dubai, which is up 1.07%. Elsewhere, we get a sense of how Saudi and Qatari exchanges closed on Thursday. Saudi was down 0.32%, while the Qatari exchange printed a 0.72% in positive territory. Now, Germany has seen a number of strikes as of late, with teachers, nurses, and retail workers taking to the streets fighting for higher wages. Another major rail strike has just been announced. Lars Halter is with Deutsche Welle and joins me from Berlin. Lars, what's behind this right now?
Well, thanks for having me. Yeah, the problem for workers in Germany and in other European countries as well is that even though their wages have been going up, they are currently not keeping up with inflation. In fact, real income for Germans was down by 4% last year. That's according to numbers that have just come out. It's worse than analysts had expected, and it's of course due to higher consumer prices. Those have gone up 6.9% last year, and that means people make more money now, but they can afford less as everything has gotten more expensive.
So how bad inflation in Germany? You just talked about that. How are markets dealing with this?
Well, currently inflation is at 7.4%, and to stay with last year in 2022, it was 6.9%. And those are significant numbers, and we shouldn't forget that the number was much higher in some months, at some point even topping 10%. Obviously, much of the rise in prices is due to Russia's war in Ukraine and the changes to the energy markets. But food prices have gone up as well, and I guess here's an example of how inflation impacts every niche of people's lives. We're heading into summer now, and the first ice cream cafes have opened with prices that can really ruin your appetite. A single scoop of ice cream can cost up to €2.50 in German cities, and that is 20 to 30% more than last year. Now, ice cream, of course, might not be a basic consumer staple, and you can certainly do without it if you can't afford it. But still, it's a good example for what we're dealing with here, because the price hike reflects several inflation factors. All the ingredients have gone up on one side. That would be the food prices, with sugar costing 60% more. Glucose, which is part of the recipe, is up 100%, so it doubled in price. And some other ice cream ingredients have even gone up by 250%. But there's also the energy cost. Ice cream, of course, needs refrigeration, and that costs around 30 to 40% more right now. So ice cream might be a small part of everyone's bill, but it illustrates how higher costs across the board add up in the end.
This is how they're dealing with the numbers.
Well, investors are expecting more interest rate hikes. It's as simple as that. The ECB has raised its rate 6 times since last July, and the May meeting next week will likely bring another step. Raising interest rates, after all, is the most efficient instrument the central bank has to tame inflation, and they're using it. Of course, for many, this means that loans, including mortgages, are getting more expensive, so that also adds pressure to the economy.
Thanks so much, Lars, for that update. Now we move over to Asia, where markets largely rose on Friday after the Bank of Japan kept its monetary policy unchanged in the first monetary policy meeting chaired by the new governor, Kazuo Ueda. Japanese markets were all higher and led gains in the region, with the Nikkei 225 closing 1.4% higher at 28,856 points following central bank's decision. Now, Australia's index was also up 0.23%. We also see the Kospi up 0.23% to close at 2,501 points. We move down to Shanghai, where we see the index up 1.14%. The Hang Seng Tech Index is also up 0.27%, while all other markets are following what's happening in Japan and seeing how the monetary policy decision affects their investments. Now, U.S. stock futures fell slightly in early Friday trade as investors digested the latest round of corporate earnings, including results from Amazon. Dow Jones Industrial Average futures fell by 0.29%. S&P 500 and Nasdaq 100 futures slipped 0.34% and 0.31%. Amazon shares were down about 2% in extended trading after initially rising following the online retailer's first quarter results. Intel shares climbed more than 4% after the semiconductor firm beat estimates on the top and bottom lines. Let's have a quick roundup of yesterday's trading activity with Maria Bird.
The U.S. stock market took an upward swing on Thursday as the Dow Jones was up by 1.58%, the S&P 500 up by 1.96%, and the heavy tech Nasdaq was up by 2.43%. This was unexpected as there was a cooling on the economic reports. This was expected to have an impact on the stock market, but many investors are hopeful and looking at heavy tech industries like Meta's reports, which showed an upward swing for the company, which is very much in alignment with other tech companies this week. It is clear that investors are hopeful for the future of the U.S. stock market and hoping that the cooling of the economy does not have an adverse effect on the stock market.
Thanks, Maria. Oil prices now were a little changed early on Friday, but are set for their second weekly drop as disappointing economic data from the U.S., the world's biggest crude user, and uncertainty on further interest rate hikes raised concerns about future fuel demand. Brent crude futures for June were trading up at $78.53 a barrel. U.S. West Texas Intermediate crude was up 0.3% at $74.99 a barrel. Now, Brent is set to decline this week by 3.8% and is down 9.1% in the past 2 weeks. WTI is on a path to drop 3.8% this week, taking its 2-week decline to 9.4%. Now, in the metals market, gold prices were poised for a second monthly gain on Friday as lingering economic concerns drove investors to the safe haven asset, while markets turned to their focus to Federal Reserve's meeting due next month. Spot gold edged 0.2% lower to $1,983.89 per ounce, but was up about 1% for the month. U.S. gold futures eased 0.2% to $1,995.30. Elsewhere, spot silver fell 0.2% to $24.92. Platinum shed 0.5% to $1,071.71, while palladium added 0.3% to $1,499.35, all headed for monthly gain. Now to Nigeria, where as businesses and households suffer the unintended consequences of the cashless policy by the Central Bank of Nigeria, Nasima believes the CBN should continue to intensify awareness on other payment channels to achieve the benefits of the cashless policy.
At the onset, people suffered untold misery because of lack of the new currency when it was newly introduced. Our members suffered, businesses suffered. On one instance, those selling food items lost a lot of food items, especially the consumable ones, because there was no money available. We still need more awareness. I don't expect central bank to go back and sit down. No, there has to be more communication to the rural areas and look into the banking availability in the rural areas. I remember that a state in the north, the central bank had to take money into the farmers inside the bush. This is the arrangement that has to be in place so that every other person will be carried along in order for this process to be effective. And don't forget that in most countries, you don't go into UK with more than 10,000, 12,000 US dollars. America is 10,000. If they come to your house and find $50,000, you have an explanation to make. Because that money can cause a lot of distortion in the economy.
Now, in Kenya, concerns that the country is heading towards a bond default are ramping up. The shilling has taken a hit, dropping more than 3% in the past month, one of the worst performances globally. Yields on dollar bonds due 2028 climbed to 14.6%, on track for 14th consecutive day of increases. And the country has delayed paying civil wages amid financing constraints. Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, joins me to unpack this. Matt, good afternoon. It's always good to have your perspective on the program. Now, Kenya has a principal debt payment of $2 billion due next year, compared with foreign reserves of about $6.3 billion. How likely is it that Kenya will face some form of public debt distress this year?
Well, firstly, thank you for having me on the show today. So, certainly, we do expect to see Kenya's fiscal pressures become more pronounced over the coming year or so, and this is being caused by what we think is causing this debt distress is rising global and domestic interest rates, and this is being combined with shilling depreciation. So these two factors are making debt servicing costs escalate in Kenya. So the government is struggling to pay or service its debts affordably. And the government has also seen an increase in its public debt levels because over the last few years, it's had to bail out a few state-owned enterprises, including Kenya Airways and Kenya Power, for example. So in terms of whether we think there's going to be debt distress or even a default, the one country we could maybe compare Kenya to would be Ghana, which defaulted on its international debts a few months ago. Our base case view for the next 6 months is that there is unlikely to be a default for the time being. So 2023, we're a little bit more confident that there's unlikely to be a default. And this is for a couple of reasons. One is that the government has brought forward a number of new revenue collection measures. It is increasing taxes, and it has made a pretty clear commitment that it will be prioritizing debt servicing and payments on debt. And this will come at the cost of things like, as you have already mentioned, civil service wages. We're also expecting to see a very significant cutback in public investment in infrastructure, for example. So certainly there will be quite significant sacrifices to avoid a default this year. Next year, however, assuming the economy, or if the economy doesn't pick up and doesn't accelerate, then a debt default is still possible in 2024, although still not our base case.
You talked about Kenya diversifying its revenue sources, but is that enough right now? Because I know that the World Bank and the IMF did project that with Africa, especially the vulnerable countries, less developed countries, are going to have a huge debt on their hands, a huge debt burden, and this because of the high interest rate environment that we find ourselves. How do you see this impacting Kenya and the revenue that you've mentioned? Is it able to match the high interest rates that is prevailing at the moment in terms of payment of their debt?
In terms of payment of debt, yes. So it is a very big question, and I think it's worth taking a step back and thinking about why the region and why many African countries are in this position. One is, as you've mentioned, interest rates are rising. currencies have been under significant pressure. Many currencies have lost a lot of value, like the shilling against the dollar over the last 6 months or so. And many of these factors were not really anticipated, especially before the war in Ukraine had this effect on interest rates and inflation. So the question is, if interest rates remain elevated globally, so if the US Federal Reserve keeps interest rates elevated, which we expect it to do, then bond yields, pressure on currencies will remain high, and this will mean that governments will struggle to repay debts. The question is whether or not governments can mobilize new revenue-generating measures, so increasing taxes, increasing tax collection measures on the private sector. If that is effective, then we are likely to see most governments avoid default or increase their revenue base. But I would say there's a lot of uncertainty at the moment, and it also depends on what happens to economic growth, because if economic growth does not increase, then the size of the economy won't increase, and therefore tax revenue collection won't necessarily increase. So a lot hinges on whether or not countries like Kenya are able to accelerate growth and stimulate greater tax revenue collection over the next year or so.
We talked about the country's growth projection. How much of a squeeze will this impact have on the public finances, and how would that affect the growth projection you probably in front of you have mapped out for Kenya?
Yes, that's right. So I would say, well, firstly, we have downgraded our growth view for Kenya in 2023 and 2024. We've downgraded our growth view by about a percentage point. We were previously forecasting about 4.5% this year and 5.5% next year. That's more likely going to be about 3.6% this year and about 4.5% next year. So a fairly substantial downgrade, and public finances, or squeezed public finances, are a big contributor to this downgrade. And this is because over the last couple of years, we were expecting to see an acceleration in public investment, an increase in spending on things like the National Health Insurance Program in Kenya. But actually, we are certainly going to be seeing the government pulling back on these investments, pulling back on spending. And this does remove a very big source of demand from the economy. It also has secondary effects like civil service wages being delayed. That affects consumer spending in the market. So certainly, public finances being squeezed is a big contributor to this, but unfortunately, Kenya is also being battered by weaker investor sentiment, partly as a result of the social unrest that we've seen in the country over the last quarter or so. So we are expecting to see first quarter and second quarter GDP growth to be quite muted. And there's also rising inflation and the effects of the drought in the country. So there are a number of factors which are curtailing growth, but weak public finances certainly is one of the contributing factors.
I know that the Kenyan shilling has been taking a hit now. We've even seen that in their equities market. Their index is really down below the 120 mark that we're used to seeing. So but how will the shilling be affected by these pressures over the coming year? And we're looking at investors holding on to the Eurobond and the dollar, the yields rising on that. How does that affect the shilling? Because is it going to put more pressure on the shilling as we see now?
Yeah, so one message I would like to emphasize is that the shilling does face more downward pressure. Our view is that the shilling will likely end the year closer to 150 per dollar. And there is a scenario where if bond yields continue to rise and it looks like the government is struggling to service its debts, the shilling could end the year closer to 160 or 170 per dollar as well. So, the shilling has, as you mentioned earlier, has been one of the worst performing currencies against the dollar globally. This has partly been a result of a massive buildup of foreign currency shortages for the private sector in Kenya. Most of the clients that we've been speaking to over the last 6 months have said that they've really struggled to access foreign currency to repatriate their earnings. And so this has kind of compounded the difficulties for the currency. Our view is that emerging market currencies in general will remain under quite a lot of pressure over the next year or so. The shilling is no exception. So certainly we would expect quite substantial downward pressure, continued depreciation of the currency, at least until late Q3 or Q4 this year.
Such a grim outlook, Matt. We hope for much better expectations, as you mentioned. Thank you so much, Matt Kindiger, Practice Leader, Sub-Saharan Africa Frontier View, for joining us on the program, sharing your perspective.
Thanks for having me today.
And now, still on the bond market, Nigeria's dollar bonds posted the biggest losses among global emerging markets yesterday after the federal government signaled its plans to remove energy subsidies that will now be delayed beyond the June 1st deadline. According to Nigeria's Finance Minister Zainab Ahmed, the subsidy plan can't be ended while the government transition is in progress. The announcement has shaken investors' confidence, with many fearing that Nigeria's fiscal crisis will worsen by the action to delay subsidy removal. Debt due 2051 fell almost 2 cents on the dollar to post the worst performance among 645 bonds in the Bloomberg Emerging Markets Sovereign Index. 11 other notes with different maturities from the nation figured in the 20 largest losers after Nigeria reported the collapse of the subsidy removal plan. Meanwhile, following the National Economic Council's NEC advice to federal government to shelve its subsidy removal phase-out plans, experts have voiced concerns as to why it is difficult to do away with fuel subsidy in the country. One is from Mr. Olukunle Ariyo, CEO, Brute Consulting. He believes it's time to phase out fuel subsidy as Nigeria can't afford to continue subsidizing petrol.
And we talked about giving people 5,000 or how much. Maybe we talk about 50 million Nigerians. So if you have about 133 million Nigerians in multidimensional poverty, and you are only going to help 50 million Nigerians with about 5,000, naira, what are we really talking about? And when you look at this subsidy thinking that we discussed, our consumption is 35 million barrels per day, 34 million liters per day. Okay, the subsidy covers 59 million. So we have about 24 million that can be classified as fraud. All we need to do, let's even say we want the subsidy to continue. Okay, we're going to say it's 35 million that we consume per day. It's not going to exceed that 35 million. So we want to investigate what happened to the 24 million. Who are the culprits? And somebody is able to take an action to say, you know what? We have jailed XYZ, we have closed down this business, we have closed down that business. The man in the street, that's what we have to understand. That man on the street will not mind to pay the actual cost of petrol because he knows that, yes, I'm paying, I'm getting something in benefit, and those who are fraudsters, who are causing trouble and headache for us in this country, they are in jail. But why is very difficult? Over the years, for almost 25 years, or more than that, thereabout, why is it difficult to remove subsidy? Because you discover that those who need to sanction it are beneficiary in one way or the other.
Now, the International Monetary Fund, IMF, has approved a 38-month extended credit facility of about $191 million to the Central African Republic, with an immediate disbursement of about $15 million. In a statement, the IMF says the arrangement will help the Central African Republic, one of the world's poorest countries, address protracted balance of payment difficulties, provide basic health and education services, and undertake reforms. Botswana's central bank has kept its monetary policy rate unchanged at 2.65% despite high inflation data. Inflation rose to 9.9% year-on-year in March from 9.1% in February, far above the central bank's 3% to 6% target. The Bank of Botswana says while it expects inflation to fluctuate, it will trend downwards this year to reach the 3 to 6% target in the second quarter of 2024. And that's it on Business Incorporated. Do stay with us next week for another edition. I'm Will Ibang. See you next time.